LIBOR, an acronym for London Interbank Offered Rate, has been the worldwide accepted benchmark interest rate for measuring borrowing costs among the banks. It is basically the average interest rate that the major banks will charge when borrowing from one another. The daily LIBOR rates are published by the Intercontinental Exchange, and it is based on the 5 major currencies, including the US dollar, the euro, the British pound, the Swiss franc, and the Japanese yen, with 7 maturities, including overnight, 1 week, 1 month, 2 months, 3 months, 6 months, and 12 months. LIBOR is used in interbank products, financial products like derivatives, mortgages, and bonds, and also in consumer loan-related products. On a macro level, it is a market indicator of interest rates to be set by central banks and the general healthiness of the banking system. Coexisting with the US dollar LIBOR, the SOFR has been published by the Federal Reserve Bank of New York since 2018. SOFR is a broad measure of the cost of borrowing cash overnight collateralized by U.S. Treasury securities in the repurchase agreement market, and is basically a benchmark interest rate for the U.S. dollar-denominated derivatives and loans. It is determined by reference to transaction data from three-party repurchase agreements, general collateral finance repurchase agreements, bilateral treasury repurchase agreements transaction cleared through Fixed Income Clearing Corporation, making SOFR a rather comprehensive representation of the funding conditions of the market. The Federal Reserve Bank of New York has made an effort to phase out US dollar LIBOR by publishing the alternative reference SOFR, and everything goes back to the financial crisis in 2008 in light of the role LIBOR played in worsening the 2008 financial crisis, as well as scandals involving LIBOR manipulation within various rate-setting banks, when the world started to give another thought of the financial and banking system. LIBOR essentially reflects the average cost of short-term wholesale and secured borrowing of major banks' average, yet banks have changed their way in funding themselves, and they seldom see themselves involving in unsecured wholesale term borrowing. The result is that there are little actual borrowing to support LIBOR, and some banks have in fact ceased to submit their estimates, which in turn leads to a less representative LIBOR. LIBOR is all about the estimates from the major banks, while SOFR is about the actual transactions. And that means by using LIBOR, banks can fudge the data to yield higher profits for the derivative products based on LIBOR. On the other hand, SOFR is based on data of the repurchase agreements market, and the trading volume of the repurchase agreements market is way more extensive than the interbank borrowings, rendering SOFR more accurate as an indicator of borrowing costs. In fact, trading volume of the repurchase agreements market is larger than other money market in the United States, and the repurchase agreements market covers more market participants. Rather than relying on the estimate borrowing rates supplied by major banks, SOFR is underpinned by actual transactions in the repurchase market agreement, rendering it more reliable.
Practical tips. Transitioning to a new benchmark rate is never easy, and we may have to be alert to several points when it comes to commercial agreements using benchmark references. First, we need to watch out for the deadlines. The Fed Reserve had encouraged banks to cease entering into new contracts that use USD LIBOR as reference rate by 31st of December 2021. The UK Financial Conduct Authority had confirmed that most of the LIBOR settings seized in the US dollar first week and second month, one would be seized on 30th June 2023. Second, we have to incorporate fall triggers in the fallback rates. Triggers may be the official discontinuation of LIBOR or merely a declaration that LIBOR is not representative. Market players are seen to have included provisions providing for a fallback rate, being the specific substitute rate, or index announced by a specific organization, like the Fed Reserve or the ARRC, or the rates eventually adopted by the market. Lastly, we should be aware of the substitute reference rate adopted by different countries. In Hong Kong, there is a multi-rate approach. While LIBOR is extensively used, the Hong Kong Interbank Offered Rate, HIBOR as it were, has been widely adopted by market participants as a reliable benchmark reference, and the Hong Kong Dollar Overnight Index Average has been seen as an alternative. To conclude, as most LIBOR settings have ceased already, we should watch out for the new benchmarking of SORF to embrace ourselves in the not-so-distant future. I hope you find these brief explanations and tips useful. Don't forget to like the video, comment down below, and subscribe to our channel.